Welcome back to All Things Money. My name is David Blain, and during today's show we're talking a little bit about the Federal Reserve and quantitative easing and what may lie ahead for the economy. We also, if we have enough time, we're going to touch a little bit on the IRS and some tax issues. This is the end of the year. It's when you should be doing your tax planning. We've been doing tax planning with all our clients here at the end of the year. We encourage you to get up with whoever does your tax, or if it's yourself, sit down at your kitchen table, figure out where you are for the year, familiarize yourself with the thousands of pages of new tax laws that have been enacted. Familiarize yourself with what may or may not happen in the next 30 days in regard to income tax rates, and then try to figure out what you need to do by year end. Because once 2011 hits, it'll probably be too late to do any tax planning. A little bit of humor there, but it is very difficult right now to do any tax planning, as the majority of the Bush-era tax cuts are scheduled to expire December 31st of this year, unless our Congress takes some action before then. But I've skipped the first part of the show, so let's kind of back up here and give you the phone number, which is 252-633-0107. I get kind of excited on these topics. I forget what I'm doing here, but you need to know how to get a hold of us. So 633-0107. Email allthingsmoney@dlblain.com, or visit us on the web, www.dlblain.com. There you'll find, you can email us from there. Of course, our phone number's there. You can find out information about myself, the firm. We post a lot of our past newsletters on the website. You also find archives of the TV and radio show if you want to listen to previous shows, or if you miss a segment for today. Okay, so back to the topic at hand. Make sure you're doing your tax planning before year end as best you can. Now, before the break, we were talking a little bit about quantitative easing, the Federal Reserve, and things like that. And I was explaining how the majority of the Fed manipulating interest rates and the markets, I feel, as well as a lot of other people, this is what's causing the booms and the busts in the various markets, the stock market, the real estate market, things like that. And so we were just going to go into a little bit of a history for maybe the past 20 years. I'll just go back. Under Alan Greenspan is really where these aggressive tactics have been most prominent. Certainly there are times in history where the Fed, after it was enacted, have been involved in the economy, but there was, for those of you that don't remember or maybe weren't around, there was a recession back in the early 90s, 1991, a very moderate, mild, and so the Fed decided to stimulate the markets by lowering interest rates. And that, in part, now not all of it, but in part led to the tech boom and tech bubble that collapsed in 1999, 2000. I mean, the earnings were up to 65 times earnings for growth stocks. And some of that, of course, was due to the optimism for tech stocks, but there was also a lot of easy money floating around at the time. And so you have this epic bust in 2000, and panic struck the Fed, and they come back in and they stimulate the markets back with essentially negative real interest rates for 3 years, 2000, 2001, 2002. And then you have the market running up again in 03, 04, 05, 06, 07. It was truly a global bubble. The stock market certainly went up, but real estate was the big one. It was a global bubble in markets, and real estate in the U.S. really got out of control. There was also to the bond market to some degree. We talked a little bit about bonds being a bubble on the last show, and I don't necessarily think they're in a bubble, but they certainly benefited from the falling interest rates. As rates fall, the value of bonds also goes up. And of course, it broke. The stock market had its meltdown. Real estate had its meltdown. And so you can't control this. You can drive the market higher, but eventually you're going to pay the price. When assets get overvalued, it's sort of a natural law that eventually they have to snap back to their true pricing. I like to use the analogy of a rubber band. If you pull a rubber band and you stretch it to its limit and it snaps back, it actually snaps back to its a shape other than what its normal shape is. And so when you stretch those valuations, they typically snap back and drive below fair value before settling back up at their fair value. And so you have a lot of these problems when the Fed gets in there and stimulates too much. You have this boom and bust type cycle. That's a lot of it, I think, is attributed to what they do with interest rates. So the big question is, what do you think ought to be done? Well, I'm not a politician, and I don't have all the answers. Our specialty is personal finance, not global macro finance, but I do have some suggestions and some ideas that I think would help with these things and help prevent them in the future. The first is, I don't think the Fed is really designed or should be involved in the economy to the degree that it is. Everybody sort of looks to the Fed to solve everything, where really their mandate should be monitoring and keeping the money supply is their main thing, and if they really insist on is keeping inflation in check. Those are the two things that it should be doing. I really think they need to stop getting involved in manipulating the markets. Well, we'll finish up on this topic when we come back from the break on the Federal Reserve and interest rates. For All Things Money, my name is David Blain, and we'll be right back after a short break.